Hello, this is Larry Diapers at Cannon Financial Institute. I'm an Executive Vice President, and I have worked at Cannon for over 3 decades. I've devoted my career to working with wealth advisors, and particularly in the investment management space, retirement planning, and lifetime income planning. Today, we're going to be talking a little about utilizing and capitalizing on retirement assets as a new piece of legislation under the CARES Act has come into place. This is part 1 of the series, and there'll be a part 2 because this section is quite long in the CARES Act. Now, the CARES Act stands for the Coronavirus Aid, Relief, and Economic Security Act. I oftentimes wonder how they come up with these acronyms for each one of these acts, but somebody is really quite good at it. But the idea and the philosophy behind this was supported by some people that you really would not usually think so. And these were backed by Fidelity. It was backed by Empower, which is the second largest retirement plan record keeper in the United States, Fidelity being the first, and a number of other record keeping providers. And they realized is that in this unique situation, with so many people being furloughed, laid off, and not working at all, that something had to be done to put cash into these people's hands to take care of the day-to-day responsibilities. So utilizing and capitalizing on retirement assets is a different framework that we as advisors need to do, because extraordinary times cause clients to need access to this cash for their essentials. Now, there are 2 main alternatives that I want to talk about in the Act, and that is, number 1, borrowing from 401ks, 403bs, and 4057 plans. A major change in that, and there's some misinformation about that I want to clear up as we go through. The second thing is taking penalty-free, and that's the key concept, withdrawals from IRAs, SEP IRAs, and simple IRAs, penalty-free. And there's some actual very advantageous tax consequences beyond the tax-free penalty withdrawals that can be taken from them. So let's get into the details of that first and foremost. So how about borrowing from 403bs, 401ks, and 457 plans? The first thing is we're going to talk about is this. The loan amount requirement, as we all know, is under 72P. And technically the old law says that a person cannot borrow greater than 50% of their vested account balance reduced by the highest outstanding loan balance in the previous 12-month period, not to exceed $50,000. How it's been changed to is that it's been increased to 100% of the vested account balance. So that's the first major change. And then not to exceed $100,000. Now, the unique thing about this is that $100,000 limit is for an individual, much like the 402G deferral limit this year of $19,500 is for that single individual. So if they even have an abandoned 401k plan at a previous employer, they could borrow from it. They could borrow from their current employer also, as long as the total dollar amount does not exceed $100,000. Now, this limit is also reduced by any outstanding loan balance in the previous 12-month period. But also the unique thing about it is that loan repayments do not have to start or begin until January of 2021. It would not make a whole lot of sense if you had to borrow money from a 401k and immediately have to start paying it back when you're in a financial crisis. And the unique thing is that the interest will in fact accrue during this tolling period, and then the loan will be re-amortized after the delay period of the loan. Now, the other thing that has not gotten very much press at all, that all existing retirement plan loan payments may be delayed if the plan sponsor wishes to up to 1 year. And that will not cause the loan to go into any default. So if you had a loan, a 5-year loan, and it's got 1 year left to run, no more payments would have to be made during this year. All payments for this year would be waived up until next year, and the loan payments then could commence in 2021, which in essence is extending that loan period to a 6-year loan period, which does not cause that to any default to take place. Now, the accrual, as we know, will take place on the unpaid amounts during that time frame, but I'll get back to that because that's not a bad idea. So the idea that all existing loans are now allowed to go on or exceed their current loan period as they are currently drafted. Now, that'll take some work behind the scenes that we can work through with plan sponsors, but you need to bring it up. So let's take an example. Recently, it just happened that I was working with, names taken out and changed, John and Mary Smith. Both are employed. Both were furloughed for up to 4 weeks right now. And the Smiths have 3 children. They're very concerned about meeting their financial obligations for those 3 children. John currently has a 401k plan with a vested account balance of $65,000. Mary also has a 401k plan with a $120,000 vested account balance. So in the worst case scenario, John could in fact borrow $65,000, 100% of his vested account balance. So if it was a safe harbor plan, even the employer monies could be taken out of that as the match, because they must 100% match. And Mary could borrow $100,000 from her plan. Both then could pay them back. Now, that would be an extreme case that you would go to, but I want to make sure that each individual is separately treated on how much loan that they can borrow from their plans. Now, payments for both of the Smiths then would not have to start until January of 2021, so we'd have all of this year, and they don't have to take all the loans at one time. They could take it in piecemeal along the way. But we've got to make sure, if that's the case, to check with the plan sponsor if they're only going to allow one of these types of loans for the year, or if the plan itself may only allow for one outstanding loan per participant per year. Now, the beauty of this whole part is, why would we ever encourage one of our clients to withdraw money from a loan and take a loan? The reason is this. Number one, there's no 10% excise tax on the amount that they're borrowing from. Number two is that there's no income tax on the amount that they withdraw from their 401k plan. No income tax whatsoever. They don't have to start the repayment until 2021, and in essence, they're paying themselves back out of post-tax money, which is in essence the same thing as a bond. So when we look at this and how we want to allocate and where we would like to take these funds from, we don't want to liquidate monies that are in the equity market and recognize a down investment in that area. We would be taking them out of the bond portion of their accounts, if they have enough, and substituting this loan into the overall asset allocation for the client, and they're paying themselves back that guaranteed rate of interest on that fixed income investment, which is in essence their own personal loan. So from a financial planning concept, it's very beneficial when we think about that, because their alternative course, if they need funds, we don't want them borrowing from high annual percentage rate situations, such as home equity lines of credit. As we know, they are no longer tax deductible in prior eras when we had emergencies, they were tax deductible. So it was a good idea to take a home equity line of credit and then pay yourself back the money and an earnings on that, and the interest on that would be tax deductible. But in this situation, we're repaying ourselves at a reasonable rate of return when you look at what is available in the bond market at the present time and talk about it as a bond substitute. And then finally, as I mentioned, they don't have to start doing this until 2021. They then can do it through payroll deduction on a monthly basis. You can rework their budgeting with them and set them off on a better course of action moving prospectively. Now, the summary then of all this, number one, biggest, and I think best way to go is the 50% vested account balance has been removed from the loan requirement. The $50,000 loan requirement was removed, and it's been substituted with 100% of the vested account balance, which means it is included employer monies in there if it's vested in those, up to $100,000. Now, this applies to loans taken with 180 days from enactment of the CARES Act, which just went through. So we talk about it to clients in a very different way. Is in essence, you're borrowing the money from yourself, and then you're going to start paying yourself back over a 5-year period beginning in 2021. To most people, this is a great idea that they're not aware of, and you're not hearing about it much in the popular press at the present time. The second major feature that we wanted to talk to today is taking penalty-free withdrawals from IRAs and SEP IRAs and simple IRAs. So what are the rules on this? The rules on this is that there are penalty-free withdrawals from IRAs or 401ks or 403bs or 457 plans up to $100,000. So we've talked about the $100,000 loan. Now we're talking about penalty-free withdrawal from their IRAs or from the 401k if they don't have a loan. And the relief is available for a 1-year period up to 12/31 of 2020. So they don't have to do this immediately. And it can be for an individual who has been diagnosed with COVID-19. It can be the spouse or dependent of a person with COVID-19. It can be an individual, and this is the big one that we're seeing with such high layoff and furlough numbers right now, who experience adverse financial consequences as a result of being quarantined, furloughed, laid off, or even having working hours reduced due to COVID-19. Also, an individual who is unable to work due to a lack of daycare or child care due to COVID-19. Or finally, an individual who has closed or reduced hours of businesses owned or operated by the individual due to COVID-19. Now, the unique thing that we have here is that if you are self-employed, you can do the same thing as a penalty-free withdrawal from your own KEO plan in order to do this technique to get to assets. And you can use it for anything that you want. It is not, in fact, earmarked for any type of monies that it has to be spent on, like all the other hardship withdrawals that we're used to talking about in our business. So what else can we do? What else can we talk about now? So there is no 10% early withdrawal from traditional IRAs, Roth IRAs, SEP IRAs, and simple IRAs. So any one of your clients in that category who have any one of these have to realize the details of it. So there's no withholding on those distributions. Normally, even if it would be a lump sum withholding with a lump sum payment, there would be a 20% withholding. There is not on here. There's no W-9. Now, distributions are included for income tax purposes as we would any withdrawal from an IRA or a traditional IRA. But the repayments are allowed to take place as if it were a loan. So it's really taking the loan from an IRA over a 3-year period commencing in 2021. The other beauty of it is the repayments can be made as a trust-to-trust transfer back into that account over that 3-year period. And for income tax purposes, you are able to prorate the taxes on this early withdrawal over the next 3 years starting in 2021. So what about if they have a Roth IRA? Well, there's a little bit of a difference that makes it even better. First of all, there is no income tax on the withdrawal as long as they're withdrawing principal only, because they have used after-tax money in the Roth. So there's no 10% early withdrawal penalty. There is no income tax ramification on the Roth. And 3, they can pay it back over the next 3 years, commencing in 2021, back into the Roth IRA. Now, if they do dip into earnings from the Roth, they will be taxable pro rata as the traditional IRA over a 3-year basis, but they also can be paid back over that 3-year basis, and as a result have an earnings rate attached to it if you want to look at it that way, because they are in fact using post-tax monies to do that. So when you look at that, it really is an interest-free loan, if you will, if they decide to pay it back with post-tax dollars from both traditional IRAs and Roths with post-tax dollars, but it has a 3-year amortization of that they can pay it back, but they only are paying back the principal. Now, rather than, once again, turning to traditional sources of credit with high annual percentage rates, such as credit cards, home equity lines of credit, payroll loans, anything of that nature, it makes more logical sense to take funds from an IRA penalty-free, repay them into the IRA over a 3-year period starting in 2021. This, in a sense, as I've said over and over again, is borrowing from their future retirement funds today and then paying themselves back over the next 3 years with after-tax money and reinstating their retirement plans in place, and also depending on where they withdraw the funds from the account, their dollar cost averaging back into the market and not recognizing a substantial loss by taking it out of the equity portion, but rather taking it out of the bond portion of their investment and thinking of it as a bond of paying themselves back, and dollar cost average going back into the equity market over time. So the hardship withdrawal pieces are this. Up to $100,000 can be withdrawn without early withdrawal penalty. That's an aggregate number per individual from their IRAs. So husband and wife, if they both have their own IRAs, could not exceed $100,000 each. Taxes can be equally spread over 3 years prospectively. Funds can be repaid over 3 years. And remember, individuals over 59.5 can still withdraw without that 10% penalty, and under the CARES Act, they then also can repay these funds back into their IRA accounts over the next 3 years so they don't damage their future retirement plans moving prospectively. So in conclusion, you've given two very, very strong things that you can take to your clients on loans and hardship withdrawals and work with them to get them through these difficult financial times. I'll be coming back to you with part 2 and the remainder of the CARE Act in the next broadcast. Thank you for your time today.